Paul, we talk about Intel all the time. You love it. I love it. Jimmy loves it. Jimmy's here.
I do love it.
Jimmy,
I own it.
Jimmy from Learn to Invest drove all the way out here to Akron, Ohio. Gorgeous Akron, Ohio. It's rainy and 66 today. And we welcome Jimmy to the show. Jimmy, I was a huge fan of yours before we even started this show, watching your videos. In fact, the first one, Paul, I was like, who's this Jimmy guy? Because, there's nothing. The way that Boston, New Jersey accent just tickles your ear is so sexy, Jimmy. You know this.
With the Boston, New Jersey accent combined, I was wondering.
I get made fun of a lot, yes.
Yeah, I was like, what is going on here with this accent? I still like him. We did a review of him. We did a
yeah, that's right. We did that's right. We reacted to a Jimmy
reaction video, and
which crushed his soul. I mean,
well, I teased him for his Nautica shirt, which he's not wearing. But then his father,
I ripped it
can I tell a story? His father,
Sure.
So most people, when you get a reaction video done of you, it doesn't go very well, especially coming from us.
You
He sent the video to his father, and his father didn't even watch the video. And he just wrote back, F these guys, which I don't blame him for saying that because...
We get that in most of our comments.
Yes, exactly. But then Jimmy's like, no, Dad, watch the video. And then he watched the video and realized the only scathing criticism we had was, man, this guy really likes Nautica shirts.
Today we're talking about Intel. We will get both Paul and Jimmy's opinions on this company, why they own it. We'll use our 8 pillars, look at the financials. We'll get Jimmy's take on these 8 pillars. And Paul, why don't you take it away? And Jimmy, you're going to cut in whenever the hell you want, baby, because I want to hear what you got to say about this. Paul, why do you love Intel? And we'll ask Jimmy the same question.
Great. First off, follow us on Instagram. It really helps our egos. So Intel is interesting. So one of the first things I want to talk about with Intel, for all of you out there who don't understand that stocks can do very poorly over long periods of time if you pay too much. In 2000, Intel was sitting around $75 a share, okay? 21 years later, it is at $53 a share. But here's the interesting part, guys. If you look at their income over the last 20 years, in 2000, they did $31.8 billion in revenue. Last year, they did 77.6.
Good Lord.
So that's over double, 2.5 times their revenue over the last 21 years, and their stock is still down. Why? Very simple. If you pay too much, over long periods of time, you will be hurt at some point. If you paid $75 a share for a company that bought back how many shares, by the way? In that time period, they went from a total of 6.7 billion in shares to now they have 4 billion in shares. So not only did their revenue go up by 2.5 times, their number of shares outstanding dropped by 33%, and the stock is still at $53 a share versus a high of 75. So this just proves time and time again that over long periods of time, stocks are a weighing machine. In the short run, they're a voting machine. And if you look at their chart, in the short run, back in 2000, they were a voting machine. Everyone wanted Intel. I remember watching a TV show in which, I remember this distinctly. It was a girl and a guy, a woman and a man. They were getting romantic. And
that's not a TV show, Paul. That's a...
No, but so the woman was a model, and the guy
man.
was a business person. And the guy was like, hey, let me see some of your portfolio. So she shows him some of his portfolio, and she goes, let me see your portfolio. And he shows her his stock account. He's like, do you have any Intel in there? And he said, yes. And she jumps on him and starts making out with him. I remember this to this day, because I remember being like, wow, that's so funny. And now I look at it going, well, 20 years later, that stock hasn't gone anywhere. And she was all excited because of Intel. So I digress. The whole point is, now I care about cash flow. So we have a $214 billion market cap. Look at this 5-year PE. So over the last 5 years, their average PE based on today's market cap is 12.2. What this means is if we take the average earnings over the last 5 years and take the market cap and divide it by that, 12.2. We want it less than 22.5. This is a massive check. It's almost half. Return on invested capital, 5-year return on invested capital, based on their cash flow, 12%. We want it over 9%. This means they do a good job of investing the capital that's invested in the business through equity and debt. This is a very solid company. Now, let's go to their income statement. This dead company that everybody tells me is so dead, $61.7 billion to $77.6 billion. Now, guys, I do acknowledge there's probably some acquisitions in here, which you can find in the cash flow statement we'll look at later. But the point is, dying companies tend to not rise in revenue. Income, net income, 12.7 to 18.5. Is that good? The answer is yes, it's a check mark. Number of shares outstanding, 4.7 down to 4 billion, check mark. They've almost bought back 15-20% of their shares in the last 5 years alone.
Jimmy, where does shares outstanding and buying back come into play in your mindset when you're grasping these stocks and analyzing them? What important role do they play?
Well, I think that a company that does a lot of buybacks is certainly better than a company that does a lot of share issuance. And for a company like Intel, frankly, I think that their stock is cheap. That's why I bought it. I think them buying that stock when it's cheap makes a lot of sense. If they don't have better things to do with the capital and they bring in a ton of cash, take that cash, buy back the shares, and everybody's individual piece of the pie gets a little bit bigger.
Yeah, and that's the thing. It's, Jimmy brings up, it's these companies have cash, no different than you having cash in your bank account. Their job is to allocate that capital. It's so funny. I remember a few years ago, somebody we went to high school with, he told me that his father wasn't the CEO of the company because he wasn't a marketing expert. And I remember thinking to myself, is that really what it takes to be a CEO? No, a good CEO is a good allocator of capital. Boom, that's it. If a CEO can't be a good allocator of capital, I just look at it saying, I want a boring CEO who understands how to allocate capital, because that's how they're going to drive a lot of value to the shareholders. So when stocks are really cheap, like Jimmy says here, like I agree with on Intel, and they have a lot of cash through cash flow, buy back shares. You're basically investing in your own company, buying back shares. And one of the benefits is, look at their dividend yield, 2.6%. They're saving that when they buy back shares. Now, is this an astronomical number? No, but they're basically sitting there saying, hey, every time we buy a share back, we're saving our 2.6% dividend. Isn't that correct, Jimmy?
Exactly, yeah. I think it's huge. And for me, I like to go, if we go past these numbers, when I analyze stocks, I usually try to look at the fundamentals of the business. And the biggest pushback I get about Intel is, yeah, they're great, but AMD is taking over the world.
Yeah, we hear that a
AMD
lot.
is the real thing.
Yeah.
And frankly, I like what AMD is doing. I love their business. I love their chips. I like Intel's chips too. I think Intel should bring down the price of their chips a bit. But you got to pay a lot more for the stock, for AMD stock, than you do Intel stock. And I remember when I first bought Intel shares, my average price, $45.74. And I bought the shares and I had analyzed AMD at the same time. And AMD looked way overvalued.
Oh, yeah.
And since then, the investment in Intel at $53 is, for me, it's been, the last time I looked at least, was much better than what AMD had done during that same time period. So I think the price you pay is so important.
Oh, the price you pay is everything. And as a short period of time, when did you buy the shares, Jimmy?
That is a good question.
Ballpark,
about, I'd say 9 months ago, a year ago.
Okay, so about when we were looking at it too. Yeah. I have I think my base is like $47 or $48 in Intel. It's a little bit higher than yours. But I sold a lot of puts on it, and I never got executed on those puts, so it is what it is. But either way, so the next metric, guys, is we want to look at the long-term liabilities of the company. What I like to look at is, can I take the average of the last 5 years of free cash flow? In this situation, with our software, $15.3 billion. I multiply by 5. That is 75 and, so call it $75 billion just to be conservative, $75 billion. I want their total long-term liabilities to be less than that $75 billion. Because at the end of the day, guys, companies that stick around are the ones that have less debt. Because if something happens in this world that all of a sudden their revenue falls, you want to make sure they're able to support their debt. So we want to look at their long-term liabilities. We go to the balance sheet, and we scroll all the way to the bottom. We want less than $75 billion. Guys, look at this. $44.5 billion. So if they just keep the last 5 years going, in 3 years they can pay off all of their long-term liabilities. That's usually the goal for a 1 year free cash flow. I'm looking at the 5-year average, which tends to be lower than 1 year as a company increases its cash flow. So great metric. That's a check mark there on that metric.
Pillar number 7 is free cash flow. We call this a granddaddy of them all. Jimmy, what do you think about, where does free cash lie in your importance, the relevance of looking at companies?
It is the most important thing. Generally, when on my channel, usually what I'll do is when I'm trying to value a stock, I use discounted free cash flow. Only in somewhat rare situations, maybe with smaller, faster-growing companies where it'd be illogical to project out any reasonable numbers. But with a company like Intel, to project where free cash flow is going, discount that back to today and pay less than that, I think is a fairly simple thing to do. It's not even complicated math.
Paul, what's the difference? I watch Jimmy's videos and this DCA, discounted free cash flow. We don't talk about that as much on our, but inform me what the variance of opinions.
Well, we kind of do.
Okay.
Our stock analyzer tool takes a net present value of future free cash flow. How is that different than what you're doing?
Yeah, I looked through the stock analyzer tool, and fundamentally, it's the same thing. Whether or not you project out, let's say you were comfortable coming up with projections for revenue, and then you knew free cash flow is 30% of revenue, 40% of revenue, whatever it is, those numbers are going to be fairly consistent. If they're not, try to figure out why. But they're going to be fairly consistent. So project revenue, like I think your stock analyzer tool, if I'm not mistaken, you guys do revenue growth, free cash flow as a percentage of revenue. It's the exact, you're ending up in the exact same place, just two different methods to get there.
Yeah, and my desired return is basically my discount rate.
I see.
So I do MPV. I mean, basically, guys, our stock analyzer tool is a Excel sheet that pulls the data in for you. That way, you're able to sit there and discount the cash flow that way. I mean, it's no different than what Jimmy's doing on his discounted cash flow model.
Let's get after Intel's free cash flow growth over the past 5 years. This is pillar number 7.
So 11.8 to 16.3. That's a check mark with an average of 15.28. Now, we start at 20 times free cash flow. Now, guys, this is a completely subjective number. We just start here to see where we stand, and that's $304 billion.
Come on.
Is that accurate? And the company is currently at 215. Now, does that mean it's a screaming buy? Not necessarily.
But I think that, Paul, when you show up a desired market cap of 304 and we're at 214, I do think that in my mind. So talk me off the ledge here.
Well, guys, a big part of value investing is growth. If you have two companies that are exactly the same in terms of everything about them, except one's growing 20% a year in revenue, one's growing 5%, which one are you willing to pay more for? Right? It's so funny to me, Jimmy. We get a lot of comments like, Paul doesn't understand growth. I'm like, no, I completely understand growth. I'm just not willing to overpay for growth. The same goes the other way. When people see slow growing companies, they might sit there and go, oh, this company is dead. Prime example I always give is 2011 and 12 with Microsoft. It was growing revenue at 8% a year. Everybody said the company's dead. I'm like, if it's dead, how is it growing 8% a year? Just like a company like Tesla, they're growing 30, 40% a year, whatever the number is. And I believe you can overpay for that. So here, would I be paying $300 billion to this company? No, I don't. I think Intel is going to have a hard time. They're the leader in the market. If anything, AMD is going to take away from their market share, if anything, right? So my goal is to sit there and say, let's assume just normal, regular growth rates of global GDP, or US GDP, whatever it ends up being, a very low growth rate, and we'll put that in the stock analyzer tool. And then from there, I want to see how bad people are discounting it. And I want to look at their stock buybacks and see how much that can affect the future value based on those buybacks. If
you're looking to trade Intel in a little more exciting manner, you can join this hunk across the table from me, Mo, in the Business Nation. Mo, what are folks doing with Intel and trading it?
So it's certainly at a support level right now. I'm just going to draw a line straight across, and we're just sitting right there. The downside for you to do anything in the short term is you're sitting under 4 major moving averages. You need a ton of volume coming in. Intel, I mean, it has very consistent volume, but I think it needs a good blast of volume. But from a long-term perspective, this stochastic is looking great. It's coming up towards a sweet spot. Yesterday gave it a little bit of a turnover, but I don't think it's going to continue to the downside. So just keep an eye on this thing. This thing is looking great. Yeah, Seth, I mean, this is a really good looking long-term play if it gets some volume coming into it.
Jimmy, did you get involved in any of these trades? Are you just like long-term focused, or do you ever do any of this trading?
You know, I started my career at a hedge fund where I did day trading, and I could not hack it. It didn't make any sense to me. There were guys in the room that were lifers. They were doing it. They were good at it. They consistently made money. Sure, they'd have bad runs, but over the long run, they did fairly well. I couldn't sleep. I couldn't.
Wow, really?
Oh my God, it was terrible. It was not for me. And then I was gradually learning more about long-term investing, and it's amazing. You know, the day I bought Intel, the day I buy Disney, I'm excited. I go to bed, I'm like, this is amazing. Hopefully, the stocks are down tomorrow. I could buy something else.
Yeah,
so the trading, I usually avoid it.
So remember, in trading, guys, you don't care about the fundamentals. What Jimmy's talking about here is the investing way of the world of saying, I'm buying what I perceive to be a great company at a good price or a great price, and I'm going to hold it for a long period of time and say, hey, let everything fall as they may, but over long periods of time, people will gravitate towards good value investing, right? Like they'll sit there and say, wait a second, this company's selling for a low multiple. I bought Tesla and it's gone down 20% over the last year. What am I doing? Oh, well, let me buy a little bit more cash flow. There's always cycles into what people are interested in, and it tends to gravitate at some point over value from hype when the hype loses its luster.
And I think that for me, I think the advantage to my way of thinking, my advantage for value investing is I don't mind if I'm wrong right now. I bought Intel at $45 or $46, call it. I buy Intel at 46. If it goes down to 42, I'm not wrong. Like, it's fundamentally, I'll reanalyze it. If the stock crashes one day and it goes down to 35, I'm going to read the news and see, did that fundamentally change the business? And it probably didn't. Something crazy happened. They had trouble getting the new chip out or something like that. And so I think that a lot of times people are too reactive by the stock price. The funny part is I had to write down this morning what my average entry price was for each holding, and then I had to look at what the stocks were doing. I don't check them. I don't check the price. I don't see how they're performing. When they report earnings, I'll flip through their reports. I'll listen to the management's call. But then that's it. I don't, if the stock's up or down, I get comments on the Learn to Invest channel, and people will be like, oh, great call on this.
Yes.
And I'm like, ooh, yes, it's up, but the call was really like a 10-year call.
I think a lot of our new...
Right now. What do we say? I mean,
it's the same thing, Paul.
Guys, so last night we're at dinner.
Yes.
And every single time Jimmy's talking, I look at Seth and go, Seth, what does it sound like? He goes, it sounds like you. I'm like, we just all talk the same. And the thing I always say to our viewers when they say, Paul, you were right on this one. I'm like, no, thank me in 10 years when your performance, your mindset has changed, your process has changed, and your returns are better over a 10-year period. I could be right or look at Alibaba. I bought Alibaba. My cost basis is 175. It was at 150 as of yesterday. And the only reason I knew that is because I had some puts on it, and it happened to alert me and say, hey.
That's right, Paul. I remember we did a video while Alibaba was at 194. You said, I hope this goes to 150.
I have puts at 150 and 100 on Alibaba. I think 130 as well. And I just sit there and say, I believe people are over-dramatizing the issue with China, and I'm okay if the stock falls and keep dollar cost averaging on the low side, because I do believe. So the same thing we do with all investments. So anyways, I did a stock analyzer tool.
Go ahead.
So guys, part of the stock analyzer tool, you're able to now pick 3 different methods if you want low, middle, high, just low and high, or just one value level. I like to do 3 just to get a basis. So what I did here was I did 7 years like I always do. People ask me why. I just say I'm used to it for real estate. I picked revenue growth. I did my low number. Jimmy, what do you think? I did negative 2%. You think that's too conservative?
For growth?
Yeah, so I'm assuming they're going to decline. I'm assuming AMD is going to chip away, and they're going to kill it. In the next 7 years, they're going to lose 2% a year in revenue.
I do think it's too conservative. Only because I think that what Intel does, what AMD does, the implication of having negative growth is that there's a stagnant market, and AMD is taking away from Intel. But I think that the market is growing. I mean, there's going to be chips in everything.
So you're saying that Intel will have a smaller piece of a bigger pie, though?
Exactly. I think that if they grow, I was just starting to fill that out, and that is not it. But I was like, let me put in my own numbers, and I started at 2%, 4%, 6%, because I think that's 4% seems like a reasonable number. It's a 10-year average. But I think that for them to go negative, it's possible, but AMD would have to go gangbusters. They'd have to go faster than people start adding chips to your refrigerator and your vacuum.
Of course.
It's because we have our first discrepancy in numbers, and I'd like to see both of you get after. So what we'll do, Paul, is stock analyzers behind you, and Jimmy will use the same tool. And I want you guys to keep discussing numbers. I really like this. I'm frothing at the mouth, as you can probably tell, Paul. Go ahead.
Yes. So, when Jimmy was at dinner last night, and I always said, he sounds exactly like me. We sound like each other. But you got to remember, every value investor sounds similar, but their approach and their assumptions are going to be different. That's part of the art of investing. I'm trying to look at it and say, let's say I'm wrong. Let's say that Intel does lose market share and it's not what Jimmy says, and the market for chips is stagnant. I think he makes a very valid point. It's not a stagnant market. As economies emerge, as products emerge, there'll be more and more growth in the chip sector. But either way, I did -2, 0, and 2% revenue growth over the next 7 years. Share buybacks. I had 2% share buyback, 2.75, and 3.5% share buyback. Profit margin, very consistent over 10 years, guys. So I did 22, 23, 24. Free cash flow as a percentage of revenue. Also, my method of finding out free cash flow, I did 20, 20.5, and 21. PE, guys, I went low. I did 10, 12, and 14 for price to earnings ratio and price to free cash flow. Why? Because it's a larger company. I want to be conservative. And I think you're going to get your major growth from share buybacks and growing the cash flow. I did my 15, 12.5, and 10% returns. Again, being conservative. I hit the analyze button. Guys, this here right here makes me say, oh my God, it's overpriced. But it's really funny because it's not that far from the middle. And Jimmy, and this middle one assumes 0% revenue growth for 7 years. 0% revenue growth for 7 years for a company that's the largest chip maker in the world in a growing world of technology in which what percentage of the world doesn't even have access to regular technology every single day? I think I'm being way too conservative here. So I want to go to Jimmy.
Jimmy, your rebuttal.
All right, yeah, I just plugged in my numbers. Okay, I have, sorry guys, I'm not used to the software like they are. Okay, so I did
How many years of analysis did you do?
7 years.
Just like mine, okay.
I stuck with the same one, 7 years, 2%, 4%, 6%. Yeah, okay. What did you do on yours?
For revenue?
Yeah, revenue growth.
-2, 0, and 2.
Okay, I have 2, 4, 6. I think that the entire industry is going to continue to grow, and I think that Intel has the potential to either take back market share from AMD, but more than likely just continue to gain market share, just not as fast as AMD will. Share change, I did -1, -2, -3. I think that they will continue to buy back shares, especially down at these levels. I consider doing 0% on the low side, but yeah, I just can't imagine a scenario where they stop buying back stock. They make too much. They have too much cash.
When you say at these levels, you're talking about they're buying back at a lower stock price. Is what you're?
I think that going back to Paul's comment about a good CEO is a good capital allocator, I think the CEO is looking at their business and they know that at this price, their stock is cheap relative to the cash flow that they're bringing in. So if that's the case, then buying back shares is a good move. It's a smart move. It's a smart investment on capital. You can make an acquisition, but depending on the price you're going to pay for that, buying back your own shares might be the better move. I don't know if we have time for a quick story, but a similar concept, but from the other side, is GameStop. I know a lot of people like GameStop, and GameStop has gone crazy. And my brother calls me not long ago, back when GameStop was going nuts. And on this particular day, the thing's sky high and it's moving, hundreds of dollars it was like $100 that day, whatever it was. We spend like an hour on the phone and we're talking about, I think, the GameStop idea. There was a short squeeze, run up the price. It's a brilliant move. I think it's a little bit petty, all the hedge funds getting upset about it, because that's exactly what they do. But, I guess it's different when everybody else is doing it to you. But the reason why I tied to the share buyback is that if I'm GameStop, if I'm the CEO of GameStop and we want to grow our business, and obviously their business has been struggling, the smartest move for them right now is to issue shares. That's the opposite of buying back, but because the stock is so overvalued, fundamentally it's not that different. Buy low, sell high. If it's so high for GameStop, and it is very overvalued compared to their fundamentals, perhaps not compared to the short squeeze or whatever, but compared to their fundamentals, it is way overvalued. They should be issuing shares. That will bring down the price at the end of the day. That's going to knock down the price, but they end up with a whole bunch of cash that they can possibly grow the business. It could be a great move for a company like Intel, who is making a ton of cash, buy back shares, continue to buy back shares. I think I have -1% on the low side. I think that is low. I think it'll probably, the history, 1 year's -3, -3.8, -2.7, -2 on the mid-range is probably still a bit conservative, but I like being conservative.
How about profit margin?
Profit margin, to me, I did 21%, 23, 25. And, let me make this a little bit bigger so everybody can see it a little easier. But I think that even those profit margins, I think that their numbers are so consistent, 23.9, or just over the past 10 years, they've done 22.6%, fine, 23. Over the past 5 years, 25%. The fact that they're getting more efficient is another smart move for a company that is that large. When you get to be so big, at some point you got to say, all right, we have some excess, fat we got to get rid of here.
I didn't even think about that, but you're right, Jimmy. I didn't even think about the fact that they're so large. There's definitely going to be rooms for efficiency. You're 100% right.
Going back to your comment about all the acquisitions that they've made a bunch. And fine, in the beginning, you get that. You got to try to figure out how to work it into the system. But a few years later, you realize, hey, we're duplicating things here. We can shave down costs. And because of that, that might be a reason why the 5-year average is almost 25% and the 10-year average is 23%.
Yeah,
and you're going to get a few extra percentage points.
They've acquired Altera, Mobileye, Habana Labs in the past, so I can see what you're talking about there. How about the free cash flow as a percentage of revenue?
Free cash flow as a percentage of revenue, I think very similar story to profit margin. 21% over the past year, 21.5, 20% essentially. I actually have 20% on the low end, 21, 22. That's about in line. I don't think it'll stay up here at the 21.5. That's why I think 21 is a very reasonable number.
And PE?
PE, okay. So I do have a question for you guys with PE. The assumption is what should be the PE today or what will be the PE in 7 years?
Good
in
question.
7 years.
Am I discounting that back to today? I might be overcomplicating that a bit, but if I look at earnings per share over the past 12 months versus today's price, let's pretend the PE's 11.6. But if I looked at the next 12 months earnings per share, in theory, if it's growing, higher earnings per share, that forward PE.
Well, I mean,
would be
what multiple of earnings should, the way I do it is, what multiple of earnings should this company sell for in a normalized 7-year mark? And 7 years from now, like, okay,
Yes, okay.
Is this a 20 PE or is this a 10 PE company? And to me, that's what I'm looking for there. Not basing it on today's numbers, basing it on where should a company like this gravitate to as part of its PE expansion or contraction. For example, like somebody said that they think Tesla in 10 years is a 70 PE company. Would you agree with that?
Not at all.
What would you put the PE in 10 years at?
Depending on where the market is, but I'd say a premium, a reasonable premium to the market. Market right now is trading close to 30 PE. I think Tesla, I mean...
In a normal stabilized, that's what I'm trying to look at here. When I put this, I put it based on a normal stabilized market.
Yes.
Like, okay, so if the market overall should be 15 PE, where should Tesla be? In my opinion, if it has growth potential and is doing the things that maybe 20 on the high side.
Sure.
Intel, if its normal market is PE of 15, Intel's gonna be bigger, it's gonna be stodgier, it's not gonna be growing as much. That's why I came up with my 10, 12, 14.
Okay, I actually just dropped mine to 8, 10, 12 because, okay, 7 years from now, I think that they're going to be a bigger company. Bigger companies inherently move slower.
Okay.
And because they move slower, they deserve a lower PE multiple. You know, I think Tesla will probably have a premium to the market in 10 years. They'll probably still have good growth. They're not going to have the growth that they've had over the past 5 years, you know, because it has to slow down. Otherwise, you get, you know,
A company that's bigger than the U.S. economy at some point.
Yes, exactly. It's insane. It has to normalize at some point. So I'm also banking on, I'm assuming when we're doing these numbers, this 10, if you said you had to pick one number, that 10 is where I assume it will be. I think 10 is a very reasonable PE multiple for Intel in 7 years. So on the low end, I guess, yeah, it could be there if the whole market's trading lower. 12, yeah, that's possible. You know, I think that it depends on how you look at it. And then the price to the free cash flow, I'm actually perfectly fine with that because...
Why'd you go higher on price to free cash flow versus PE? I tend to keep those the same because over long periods of time, your earnings and your free cash flow should be very similar. So I tend to keep those numbers very much the same unless I'm looking at a company like a REIT that has a lot of depreciation that is a non-cash expense from just buying the building as opposed to improvements. So I try to keep those numbers very similar.
Yeah, I guess that makes sense.
That's my opinion. I'm not saying it's right. And I've had people comment before like, hey, why'd you change it? Because sometimes they do change the number. And there are special circumstances with companies where the free cash flow multiple and the PE multiple might be different. Keep in mind, most people care about the PE more than the free cash flow number. But you and I as investors look at free cash flow as the number one most important thing.
And I'll tell you why I didn't make them the same. It was because it is 11.6, so call it 12 to 13. So they are separate now. If I were alone and doing a video on my own, the next step for research for me would be, do these two historically trade near each other?
That's a very good point.
If 6 months from now, this is 12 and that's 13 and fine, we just, you happen to catch them on a weird day. I just assumed, all right, I'm going to call that the baseline and that the baseline. The other tricky part about doing it this way, and I think this is fundamentally one of the differences between the research process you guys do and the research process that I do, is I love the stock analyzer tool, and I love using it as here's how I'm going to find a good company. And then I have on my channel, I got 8 steps to analyze the stock, where I try to go much deeper into the companies. And we were talking about that last night, about me improving my efficiency on that, going deeper. But still, my question is, because I'm realizing I might be making a mistake here. Okay, 11.6. That is what I'm basing my information off. I don't know why that keeps getting talks, but 11.6 is what I'm basing my information on. But I also just said the stock is undervalued. So in theory, it shouldn't be 11.6. 11.6 is cheap. So if I would look at, what's the past 5 years? Should it be 14x? But how can I say that's going to be my baseline number? In fact, I put my baseline number below that. How can I possibly say my baseline number is going to be below that and it's still cheap today? You know what I mean? Like should it be trading at 14x, hypothetically? And if it should, well, that would change all of these numbers.
And this is the point of the stock analyzer tool is to be a starting point. Okay.
Yes.
If you type these down, hit the analyze button. Jimmy did 12, 10, and 8% returns. Hit the analyze button. Let's see where he ends up at. Scroll down there. All right. And by the way, when I really look at Intel the way I really want to, as opposed to being very conservative like I did, I think it's a $75 or $80 stock. And on his high side, he's there. So right now, I look at Jimmy, and the way I'd advise Jimmy, if it's you out there, is saying, Jimmy, you made some middle assumptions, and your price is well below that middle assumption. To me, then go into your 8 steps and do more due diligence. That is the point of the stock analyzer tool. The stock analyzer tool isn't about saying, go pay this price. If it's below this, you buy it all day. No. Your next step is doing due diligence, right?
I agree completely. And for the 8 steps, all the 8 steps on the Learn to Invest channel, that whole process is designed for, frankly, the first half of those steps you could probably skip if you knew the company. Like when I analyze Intel today, well, I know the company. I don't have to read the business section of the annual report. But I've had comments I've done Intel in the past, and I've had comments where people say, oh, Mobileye is going to be huge. That's why I bought it. And I'm like, well, Mobileye represents, I think, less than 1% of Intel's revenue right now. So I agree, Mobileye is awesome, and it will probably do great. But do the math as to how big they have to get to really sway Intel. Right now it's a rounding error.
And guys, this is the important part about value investing. Just like when Intel lost Apple's business, everybody freaked out, and it ended up being 1 or 2% of their revenue. And everybody's like, oh my God, they lost Apple. It's like, yeah, but Apple makes up 1 or 2% of their, I think it was something like that. I don't remember the exact numbers, but it was a much smaller portion than everybody thought. And this is part of learning from both of our channels, is saying, okay, he's right. Mobileye could very well be awesome, but for them to really make a dent in the numbers and really add to it, how much does it have to grow? That's the question. I personally would rather just start on, what's the company at today? Let me make my assumptions. Does it still make sense? Great, go forward.
Final take on Intel, Paul.
I'm still a buyer of Intel. It's actually increased from $45 a share in terms of my view of where I want to buy it at, because I think I'm double discounting on things. I'm putting a high return, desired return, and I want a margin of safety. I actually sometimes find myself being too conservative, saying, oh, I want to make 15% return, which is already a margin of safety. And if my price is at 60, I want to buy it for 45. Well, then I'm not really looking at a 15% return anymore. I'm looking at 18 to 20% return. So I like Intel. I'm buying shares. I'm selling puts to get it at lower prices. And I want it to be part of my portfolio, part of my 30 stocks that I own in my portfolio here in the next few years.
Jimmy, your final takes on Intel.
Yeah, I like it. I own it. Like I said, I own it at 45, so I'm somewhere in between here. And I think Intel's a great hold for the long term. Now, I actually think that there's 2 different ways. People ask me a lot, hey, are you buying more shares of Intel? But the way that I've been investing is, as I get more money, I'll save up money, and then I invest that money, and usually that entire piece of cash goes into one investment, whatever the investment I'm finding then. Mm-hmm. I had another guy put up a comment about, hey, I just got $100,000. What do I do? Okay, now it's a little different.
Yeah.
If you have to put it all to work quickly, this goes back to the disadvantage of being a portfolio manager. If you have to continue to put money to work, yes, I think Intel's a good buy here at 53. I'm not buying it because I own it at 45, and I'll try to find something else.
Yeah.
But if I had to put a whole bunch of money to work, Yeah, buying it here
Not
makes a lot of
100%.
sense.
For the person who has 100 grand, do not put 100% of your money in one stock. That's my advice.
I think it should be close to realistically 5%. That's what I would do. I would do 5% in as many good companies at a reasonable price that I could find. The problem with today's market is good luck finding the 20 companies that you need.
Yeah. Wow. Okay. That was hot and heavy, baby. That is our take on Intel from Jimmy and Paul. Check the description below. If you're a Learn to Invest viewer, we welcome you into Everything Money. If you're an Everything Money viewer and you have not heard us mention this man's name about 1,000 times in our past videos, it's now time to go in the link description below, find Learn to Invest, and subscribe to him as well. The software behind these two chaps can be gathered and gained for you, given to you through if you go to Patreon or everythingmoney.com. Both lead you to the same place. You can sign up for our community. You get access to the Discord channel. You can get this software within the hour and finally get a hold of your investments as you learn the financials behind them. And of course, Jimmy's going to be announcing some interesting things involving a Patreon and his community moving forward. So expect some news out of his camp in the very near future. So that's our take, guys. Fondle a thumbs up on the way out. Jimmy, thank you for your take on Intel. Fondle that thumbs up, baby. You guys, you can steal that one if you like.
I usually don't ask
Please
for the thumbs
do.
up, but that's how I'm going to do it.
Please do. Please do.
Just fondle the thumbs up.
Yep. Thanks for watching, guys. See you next video.